Okay, good morning, everybody, and welcome to State of the Market. I thought long and hard about how would be the best way to do the market update. But last week, Dave Ramsey did a 1-hour webinar on where he thought the housing market was going. And then you also had a very successful entrepreneur named Patrick Bet-David, who also did a 1-hour webinar, and he took the exact opposite position that Dave Ramsey did. And one of the things that I think is aligned with wisdom is when you have a situation like this, you have a reality that you're considering is to understand the arguments for and arguments against. Because when you do that, you protect yourself from biases, right? You protect yourself from vulnerability. You protect yourself from only wanting to hear the things that you want to hear. But when you do that, you open yourself up to positions of weakness that you otherwise wouldn't have if you just didn't understand the other side. And then, like we always say, test everything and hold fast to what's good. And so what I wanted to do today is briefly give you a summary of both, and then really do all the work I could to expose the factual data so that you could see what the real data is, and then allow you to really come to your own conclusion. Today, you're going to get a lot of information. I've got a bunch of slides. I would also recommend that you go check out Dave Ramsey's webinar, watch it if you want to. You can also go watch Patrick Bet-David's webinar. They're both for free on YouTube. And I would highly recommend that you do it just to make sure that you're up to date for why they say, why they believe, the arguments they make, and the positions that they take. But just in case you do not know who Dave Ramsey is, he is a personal finance coach, teacher. He teaches on the topics of budgeting, investing, financial literacy. He owns several $1 million of paid off real estate, and he's been in the real estate market for over 40 years. And when you look at who Patrick Bet-David is, this guy is, he's a very successful businessman. He just sold his insurance company for multiple 9 figures, and now he's on a tear here with a media company. But if you didn't watch Dave Ramsey's webinar, let me just kind of summarize his position in a very quick way by starting with what we've seen and what he points out about home prices over the past few years. Let's start in 2017, because I want you to see the trend here that he was pointing to, and I think it's helpful because the trend is always your friend. So in 2017, what did we see home prices do? Well, we saw them increase on average 7.1%. And then when you move into 2018, we saw a 5% increase and sellers profiting about 61K in that year. When you move from 2018 to 2019, what you saw is a 6.2% increase. And then we saw things go parabolic in 2020, and you saw a record-setting year with 29% increase in home prices and home values, which is massive, from 6.2 to 29%. And then going up an additional 18% in 2021. And so far, just in 2022, halfway through, we've already seen the median price rise more than $5,000 higher than where they were in January. And he notes, Dave Ramsey notes, that not only does he himself, but he cites multiple experts like Zillow, who expects another 5% increase. When you look at Redfin stating that they see a 3% increase for the year. And then Fannie Mae is going so far as to say double digits as a 10% increase. And the point he makes, and the point I would make, and I think everybody on this call would agree, that by no means are double-digit appreciation or increases in home prices sustainable, right? Well, we've seen 29%, then 18%, 17%. That it's not sustainable over the long haul. But as Ramsey points out, one of the things that we've got to see historically, right? Those who do not know history are doomed to what? Repeat it, right? So when you understand historical patterns and trends, you can let that be your teacher. And one of the things he points out is then when you look at the historical performance of real estate, it tends to go up on average 3.8% a year. And this is one thing to really, really, really understand and connect, is that it typically matches the inflation rate plus 1 or 2%. So whatever the inflation rate is, real estate tends to match that plus 1 or 2%. Now, I know some of you are like, well, you don't like the CPI and you don't believe it's accurate. I would agree with you. I think Chapwood Index and Trueflation is a truer indicator of where real inflation is. But what's interesting, and I didn't do this for this webinar, but if you go back and you match inflation according to those things, Chapwood Index and Trueflation, and then what home prices do, you will see the same consistent performance, which is very intriguing and very interesting. Look at inflation, compare it to real estate. Real estate typically does 1% to 2% more than inflation. But one of the things that he also talks a lot about, and this is something that I think is really important for us to understand, is how real estate is just simply a supply and demand game. That when there is low supply and there is high demand, you see higher prices. When there is low demand and high supply, you see lower prices. When you see equal demand and equal supply, what you see is sustainable appreciation. That's what you typically see with these supply and demand metrics, right? When you look at the reason for the demand, or what's causing this demand that's pushing prices up so high, what he does is he shows where we were in 2008, which we have 55 million Gen Xers who were in the prime age of buying a home. We have 55 million people looking for homes, okay? Compared to now, in 2022, he blames it all on millennials. Thanks, millennials. He blames it all on millennials and shows that compared to 2008, what we actually have is 66 million that fit the same category of people in the prime age of buying a home. And when you look at that data, you see that we've got 11, I don't know how I got 5 million, because 55 to 66 is 11, but you've got a difference of 11 million in this graph right here. And when we look at this, we start to see something, in my opinion, that's foundational when it comes to demand. And that's what's called household formation. Here's what household formations are. I'm just going to give you the definition on the Atlantic. Household formation means a group of people living together. Could be 6 roommates. It could be a 4-person nuclear family. It could be a family plus a grandmother. It could be a young couple of 2. It just means one or more of those categories of a household being formed. And the reason why this is important is household forms creates demand because they need a house to live in, obviously. Everybody understands this. And when you look at March 31st, 2022, we've got 1.4 million households formed, which creates demand. So you've got millennials, but it's not just millennials, it's additional people that are forming households that are creating this demand for real estate. Let's do some simple math, because this is where this really breaks down to simple 1 + 1 = 2 kind of math. When you look at the supply side of this, housing starts are new homes being started, new construction that has been started. And what you're seeing right now is you have on average about 1.7 million new housing starts. And then of those starts, you have about 100K of those that are destroyed for various reasons. Floods, fires, acts of God, whatever. That leaves you a total new supply of 1.6 that has been started, okay, just been started. Now, when you look at new home demand, you got 1.4 that we just looked at with household formations. And now you have an apparent surplus between the supply and the demand of 200K. But when you look at how many of those homes that were started actually get finished, you see only 1.3 million. Now you take the 100 that are destroyed and you're left with 1.2, and then you do the math of 1.4 new households being formed and 1.2 new homes being constructed, you have an annual deficit of 200. And what this is showing us is that we just can't keep up. Everybody understands this, but this, in my opinion, really simply states the numbers in a way you can understand, and you can go back at and look at any time to see, okay, how many households are being formed, how many homes are being built, and then how are we meeting the demand for it? And right now, we're not. We're 200K short when it comes to demand and supply, just to meet the need that we currently have for people to have homes, okay? In addition to this, here's what you see on the demand side, is that 18% of all homes purchased in the fourth quarter of 2021 were bought by either individual or institutional investors, and 75% of those transactions were purchased with all cash, all of them. And when you look at the other stat that we've talked a lot about is 40% of all homes that are owned do not have a mortgage on them. And then you look at this issue where now you have investors that are purchasing homes and they're not planning on selling, they're gonna keep them, right? And so now you take inventory, you don't have enough homes to meet the inventory need or demand need. Now what you also have is investors who are scooping up a lot of these properties. And then on top of that, you have sellers who are sitting in homes right now with interest rates of a 2 or a 3 as their first number. And now they're looking at, why would I sell my house now and pick up a home at 5 or 6%? And so now you have this inventory problem, which is why when Ramsey goes in and discusses this, what he talks about is that we simply have to understand supply and demand metrics. And when you do that, his position is that we won't see a decline because the fundamentals of supply and demand just won't allow for it. And when you look at some of the things that we're seeing right now, he does acknowledge that there's going to be more and more sellers that are reducing prices, that more homes are coming on the market, that properties are taking a longer time to sell. But when you zoom out, which is what this slide right here shows you, what you really see is it's just a blip on the radar to match where the inventory levels that we saw just a decade ago. When you look at this graph, even though we may be going up a little, it seems insignificant when you look at the historical trend. And so what we've got happening right now is really a systemic issue of supply and demand. And as he points out, since 1983, the number of homes has decreased from its peak of 3.7, which you can see right here, 3.7 million that we had available for purchase, to what we have now, which is just under 1 million in 2022, which represents, by the way, a 75% decrease from where we were in 2007, which is massive. The 75% decrease from where we were in 2007, okay? So what you see happening today is all of these issues. And so one of the things that Patrick Bet-David pointed out was, what about foreclosures? He showed an article that showed that foreclosures have increased 700%. I searched long and hard for this article. I couldn't find it. Even Black Knight shows that you've got a major difference. So if somebody can find that article, let me know. I found 2 articles that were kind of mainstream, but didn't actually cite a source. So I never could find the 700% increase. But the thing to remember is that even if there's a 700% increase, we essentially had a moratorium on foreclosures, so we didn't have any. So again, one of the things that I think is so helpful to look at when people are telling you numbers is compared to what, which is why I want to help you see, even if I'm citing a year over year increase, you can at least see where it was and compared to what. But when you look at foreclosures, one of the things that you see that's happening right now on that end is that you can see that in 06, bank-owned properties started to become the norm when buyers just couldn't afford the balloon payments. So in 2007, 2008, 2009, 2010, look at the amount of foreclosures that happened. And that happened as a result. Everybody knows the ninja loans, the no income, no asset. You just had stated income loan. And as long as you can make the initial payment, lenders were giving you these loans, and the whole thing crashed down and led to one of the biggest crashes that we've seen today. But today, foreclosure activity is an all-time low, and some are concerned about a flood of foreclosures. But the reality is we have record high homeowner equity. And last month, only 2% of mortgage properties are underwater. And this is according to Black Knight. You can see it on their market report that they just came out with. So only 2% of mortgage properties right now are underwater, allowing anyone who has to sell their house, most likely can sell their house and at least break even, and most actually would come out positive. So what about though Patrick Bet-David? Just in case you don't know who he is, this is his YouTube channel. I have benefited tremendously from the content that he consistently puts out, especially on entrepreneurship, business development. It's really good content. He argues the opposite of what Ramsey did, and I recommend that you go watch that video. He asserts that a crash is coming, and it's going to be the biggest crash that we've seen, and he looks at a number of points of data, and I recommend that you go see it. So he makes the point that Ramsey could be right, but this assumes that demand stays high while inventory stays low. We all know that that might not be the case. Patrick points out that inventory is continuing to increase, and if that continues to happen, there could be a new level of supply and demand. And if sellers now start to be afraid that they've missed the opportunity and start to increase the number of homes on the market right as we enter a recession, right as rates continue to rise, then what you have is a market that starts to drop faster than expected. And just to see how far and how fast we could drop, what I want to do is take a look at the data from some of the historical crashes, because again, this is going to be really helpful when you're just looking at what happened in the past and what kind of criteria or environmental aspects or pieces of data do we have now that could be similar, so that we can see what most likely is to happen. So I want to take a look at some of these past historical crashes so we can see. And one of the first ones that we see is what actually happened in 1929. The stock market peaked, real estate market crashed alongside of everything else. And this was one of the worst crashes in the history of real estate, where values plummeted 67%. So imagine that, yo, you just bought a house and then it plummeted 67%. That's what happened in 1929. It took nearly 3 decades for prices to come back to their pre-crash levels. Then the next thing that we saw was in the 90s, you saw difficulty here, the savings and loan crisis. It caused interest rates to rise, and new home construction dropped, and housing prices remained flat until about 1997. Those of you who were living during that time, you understand that. You were there, you saw it. It might not be as fresh as the one that I'm about to go to, which was 2008. You saw one of the biggest crashes there in 2008 because of what was going on with the banks. One of my 2 favorite movies to watch, if you haven't watched it, is The Big Short. And you can watch that happen. It's one of the best movies to see on what really took place. And so you saw what happened in 2008, where we saw home values fall approximately 30 to 40%. And now we come to 2022, where prices are at an all-time high. However, here's what I want to stress and think is really important and most interesting about all of this, with the exception of 1929, is what we see today and what the data suggests is likely going to happen. And one of the most important things I think we can look at when it comes to making sense of this whole thing is really this one word that I think more and more people have started to understand and think more about, and that is the word inflation. Inflation is where you have more dollars chasing fewer products, right? It's the erosion of purchasing power. Your dollar just gets less and less valuable, right? And there's multiple reasons for this. But one of the primary reasons that we saw this year is we just printed more of them. So now you have more money chasing fewer products. And now it just costs more of those dollar bills to purchase things than it did 5 years ago, right? This is the hidden force in the economy that I think we really have to pay attention to. And it's one that we don't often talk about or think through, but it really has a big impact. And right now I'm going to show you why and how this makes sense of it. If you would have 5 extra income from 1970 to where we are today, you still would not be able to do it and not lose purchasing power. So let me say this again. Even if you would have 5 extra income from 1970 to 2022, you would have still lost purchasing power because of inflation. Now, why does that matter? Well, it matters because when you take this into consideration with home values, what you begin to see is that we've only seen, factored in with inflation, one decline in 50 years with home prices, and that was in 2010. And that was caused by all of the shenanigans that was going on from the lending side of things. And what you see is, if anything, values have been shown to increase during recessions. And if you look all the way back to the 50s, you can see that in recessions, what you see is home values and home prices, they don't go down. What do? They go up. So look at this graph right here. This is really, really, really helpful. Go all the way to the 70s, right? Which, if you read Calculated Risk blog, he argues that the market that is most like ours today is the market in 1978, 1979, 1980, where we had record high inflation, rates shot through the roof, right? Which is what's happening right now. What happened to home prices? Home prices increased, they didn't decrease. You look at 1980, you had another recession, 1990, another recession, 2000, another recession. Here we go in 2008, right? And here we are coming up to 2022. And what you see is this historical trend that when recessions happen, what typically happens is real estate prices go up, interest rates go down. And the interesting thing now is interest rates are going up, right? They're not going down. In a recession, the Fed tends to drop rates to stimulate the economy. So what you're seeing, though, in terms of historical trends is that prices go up, they don't come down. And all of this to say, in my opinion, when you compare kind of what Patrick Bet-David and Dave Ramsey says, is that both have a point. I think one of the things to consider with Patrick Bet-David's that I didn't have time to put in here is Bet-David compares 2008 and how the average home price was 8 times the average person's income, and that today in 2002, it's 8.5 times the average person's income right now, the mortgages. And I think that's probably one of the more powerful comments that Bet-David makes in terms of the overall affordability that people have. But what I also think when you look at that is how much equity people tend to have, right? And what's their likelihood of selling that without creating some kind of crash? And I think it's high. So it's something to consider, but it's not something that I think is super concerning that I think would merit a crash. And so all this to say, I think both of them have a point, but even with real wages down, the share of millennials continuing to grow, rents increasing 17% year over year on average, it puts more pressure on the housing market with lower inventory than it once was. And so based on all of the info that I could possibly find, I can't find anything that would point to some severe or imminent real estate crash with all the information that I think is readily available for all of us, a lot of which I just shared with you. And to me, it's apparent that so many people have used real estate to leverage their money. They've leveraged their money with low fixed rate mortgages. Even now with where you see mortgages, the interest rates are, you're essentially at an effective negative situation, right? And what that means is that you can account for a 5.5% mortgage, and that makes you more money than you would have spent in pushing prices higher just because your mortgage rate is beating inflation, which we've talked a lot about. And so in terms of my own belief, for whatever it's worth, I think that the way to solve this problem is to build more homes and to be able to do that without all the red tape. But until that happens, I think it's consistent with all the data that what we will most likely see moving forward in the future is a leveling off of prices. I don't think we're going to see a substantial crash or decrease, a leveling off of prices. Maybe we'll see a 4 or 5% increase. I think that's reasonable. And I think that's going to be far more healthy in the long term and very beneficial for all of us. So as I think Ramsey and Bet-David have some really good arguments to make, that's at the end of the day how I see things going and where I think we're moving into the future, a more sustainable appreciation. But I don't see a huge correction. And I think all you have to do is look at historical trends, especially this one, to see, I think real estate has performed very strong. And for that, I'm still bullish on it. So